if you are logged in today and choose only to view, choose the view in the browser setting only, you will be able to watch, but you won't be able to participate in the chat part of the discussion. So keep that in mind. Again, I think that's about it. Given that, why don't we move on? And I'll let our two presenters introduce themselves. Again, I want you to welcome Chuck Schwerin from the Small Business Development Center and Steve Besmer from Alternatives Federal Credit Union, who will walk us through an introduction to succession planning. Chuck, Steve.
As Gary just mentioned, I've been involved in small business advising there and currently with Alternatives Federal Credit Union. I've also been a civil engineer involved in hundreds of small business development projects through many years. So I'm well acquainted with the challenges of growing and developing a small business. And today we would like to address this very important topic of succession planning, as Gary introduced. Chuck?
Good morning. So I'm Chuck Schwerin. I'm with SBDC. We've got 23 centers across the state. I'm with the Binghamton Center. We're affiliated with Binghamton University. Each of the 23 centers is associated with a SUNY college or university, with one exception in New York City with Pace University. We cover 12 counties across the southern tier, and I have hundreds of other advisors across the state that I call upon. So we have an extended network and work closely together, as well as with a dedicated team in Albany that has a resident research network that we call upon. So our services are free of charge, funded by the Small Business Administration, by New York State, and by our host institution, BU. And appreciate being invited to participate this morning. Steve, next start out.
Yeah. So I would like to begin by just giving a brief overview of what we mean by a succession plan. Couple of concepts to sort of lay the groundwork here. A succession plan in reality is just a special kind of a business plan. Business plans are, a part of the life of any business from the day, you start thinking about it, and at the end when you start thinking about turning it over. So a succession plan is essentially an extension of your business plan. One thing that a succession plan is not is it is not an emergency bailout. Sometimes businesses get into a situation where there may be solvency questions or emergencies, and an owner is looking to make a rapid exit. Good succession planning is not that. That would be more in the category of an emergency situation and would likely be dealt with a lot of different methods than a good succession plan. So having stated that, you should think of a succession plan as more of a process rather than an event. It is something that occurs over months, in fact, over years. And typically a good succession plan is started way, way before the planned exit date that's desired. You'll notice on the screen, because it is a process, we've sort of depicted this thing in a circular fashion. Think of it like a process, and any given business may enter this circular pattern at any one of these different topics that we show up there, because different businesses are at different places when they start thinking about a succession plan. So you see that we have 6 core elements to succession planning. And we've put them in a kind of logical order, 1 through 6. But again, remember, you may jump in this plan at different places, which will become more clear, and follow-on aspects of this program, which will involve mentoring and one-on-one involvement. But I will go through just real briefly these 6, and then we'll talk about them in detail through the rest of the presentation. So financials, as it states, no succession plan is possible without very accurate bookkeeping and historical data. Valuation is based on those financials. It's assigning some sort of value to the business, presumably to sell or transfer. Seller is you, the business owner, and we're going to discuss what it means from your perspective to prepare a succession plan. Buyer, of course, is who we're looking to sell or transfer the business to, and we want to address very specific issues about how you should approach and deal with buyers. Taxes goes without saying. Transfer of businesses involve taxes and tax planning. And finally, at the end of this process, we are aiming to have the business owner complete the succession plan, which, as I mentioned, is a form of business plan. So that's kind of what we're going to go into in detail now, and I'll turn it over to Chuck to start talking about financials.
Thanks, Steve. So sort of the financial status of your business is, of course, the basis for attracting a buyer. Your financial history tells a story of your business. If you've been lax in maintaining your financial records, that can be a red flag to a potential buyer. Before you let the world know you're looking to pass on your business, it's essential to make sure your financial world is in great shape. That, of course, is where a buyer will focus their attention first. How you've maintained your books is really important. Do you use a certified public accountant? I had a client the other day who gave me handwritten ledgers. Now, they may have been exquisitely done, but they're very hard for a potential buyer to analyze, efficiently. So if you're not using a bookkeeper or a CPA or software such as QuickBooks, you should seriously consider making that transition before you present yourself to the outside world. Without software, it's extremely difficult for a buyer to evaluate what you've built. Most buyers will not have the patience to pore over your handwritten ledgers and notes and analyze if this is a world that's worth taking on. How's your business trending? That's a real key point. Is it expanding? Is it shrinking year over year? Whatever that trend, is it still profitable? And revenue growth is only part of the story. Point is, make it as easy as possible for the buyer to understand what you have built. What may be an acceptable level of profitability to you may be different to a buyer who, of course, is going to presumably incur some debt in order to purchase that business. So it might have to be a stronger financial picture from their perspective than it may be to you. A few red flags to keep in mind and to mitigate before you present yourself would be things like tax liens, if you have any outstanding or pending lawsuits, payroll tax infractions, sales tax problems, UCC codes filed, environmental issues if there are any, and of course personnel issues. So those are sort of key flags to not sort of keep under the rug because you're going to be obliged to disclose everything and provide as clear a picture as possible in that succession plan. Steve?
Okay. The next area that's obviously critical to a succession plan, excuse me, is the price tag that you are considering for your business. So that's what we call valuation. How do we come up with a value to assign to your business that is realistic and meets the goals of seller while being attractive to a buyer? One of the things that I've observed in different businesses is that a lot of times this becomes an emotional issue. Of course, as a business owner or a person who's been building a business over many, many years, putting a lot of yourself, your pride, your ambitions into this thing, you become very attached to it. And it's easy to allow the emotional attachment to sort of bleed over into impressions about the value of the business. I'm also a small business owner myself, as I forgot to mention that in the intro. My wife and I own and operate Lively Run Goat Dairy and have for over 20 years. So I understand what goes into growing and investing in a business. The other side of me, which is business mentor and engineer, always goes back to the basic numbers, to the actual quantifiable value of something, opposed to my emotional sort of bias. So that's the first thing in business valuation, is to sort of step back and understand that it's going to involve a deep level of mathematical and cash flow sorts of analysis, which is why we start with financials, as Chuck described. The financial information becomes the data that we're going to use to value a business. Without the financial data, the valuation is not possible. So the way I like to think of valuing a business is to think of it in terms of a minimum and a maximum. As a seller, there is a minimum value that you're going to accept. It's just like any transaction that we do every day. If you have a used car and you want to sell it on Craigslist or whatever, in the back of your mind, you have a number that's your minimum. You're not going to let that car go for less than whatever that number is. And that number is most likely set by, could be that you have a payment left on the car. Could be that you owe friends or family for the car and you can't get out of it less than whatever it is that you still owe. So a minimum is typically driven by some objective criteria. The other side of the equation is the maximum. We often have a very high goal in mind. We want to sell that car for as much as we can possibly get out of it, and we may be overly optimistic. So the maximum, on the maximum side of it, there's market value. The market drives the maximum. In the car world, you go to the Blue Book value, you find this is what that car is worth on the market. So your minimum is typically set by your own internal needs, and the maximum is set by kind of what the market will bear. So a business valuation, if it falls dramatically outside that range, minimum and maximum, your valuation method may not be accurate. So a little bit about valuation methods. You could actually go online these days and do a little research, and you will find many different methods and rules of thumb out there for how you evaluate a business. All kinds of things, like the value of the business is 4 times its annual gross revenue, or all kinds of rules of thumb. you could ask different advisors, different mentors, different consultants, and you'll get different formulas for valuing your business. So that's why I like to go back to this concept of a minimum and a maximum. And you might go out there and find 3 or 4 different valuation methodologies, and you process them. And if those methodologies give you unrealistic answers way outside that minimum maximum range, you probably want to toss that valuation method. Once you find 2, 3, 4 of these methods that sort of fall within the range, then we'll look at averaging them or settling on a value that's realistic. So there's also very pragmatic ways of thinking about it. And a good example would be to consider, say, a business that's it's not growing, it's not shrinking, it's cruising. Let us say cruising at a profitable level. There's a comfortable level of gross revenue, costs are covered, fair wages are being paid to employees and owners, and at the end of the day, perhaps the business is netting a tidy profit on an annual basis. So like a minimum sort of thinking in a situation like that might be a buyer comes along and a buyer has to invest to purchase your business. That buyer is either going to go to commercial lending or venture capital, or perhaps take it out of their own pocket to purchase your business. But regardless of the method that buyer uses to capitalize, whether it's commercial lending, venture capital, or out of pocket, there's the cost of that money. The buyer has to recover that investment cost on top of the existing cost structure of your business. So if the profit of that business, let's say it's this cruising business, it's grossing a 10% profit, and let's just say arbitrarily that profit on the year is $20,000, but the financing cost for this buyer is $3,000 a month, excuse me, for a payment, and his annual finance cost is $36,000, then of course there's a problem, because the business structure, its cost structure and its profitability has to, at the bottom line, be able to carry the capital cost of transfer of that business. So that would be an example of how you think about the minimum value, sale value of a business. Your minimum or your price tag can't be so high that bottom line condition cannot be met. So a couple of other thoughts is that valuation is, it's definitely going to be undertaken by both parties. You're going to value the business independently, and you're going to come up with your selling price. At the same time, the buyer's going to come in and he's going to analyze your business, and he's going to come up with a valuation, or she, and then there's going to be a negotiation. No different than bartering on the street corner. You're asking a price typically higher than the buyer's going to want. The buyer's going to counter offer, and a negotiation ensues. So the valuation process has to be very realistic, very fact-based, and drill down into your financials. So that's it on valuation for now. If you have any questions, we'll take them at the end.
So just sort of as an anecdote, a client I'm working with now is interested in buying a business, and that business, a restaurant, also includes sort of the underlying real estate. They came to me and asked if I would help with valuation. I gave them sort of 2 algorithms to use, both of which resulted in a very similar number, and then added that to what they determined the value of the real estate to be, presented that to the seller, And of course, the seller wanted to know where those numbers came from, and it was very convenient and helpful for them to say, here are the specific algorithms that were used. These are industry standard. One of the tools that we have at the SBDC is a report called Profit Sense that allows us to enter in the type of business and get an analysis of what sort of a typical financial sort of health report would be sort of nationwide for that type of business. And so having that data, made their offer that much stronger and really put the onus on the seller to, defend what they wanted out of that transaction. At the end of the day, the value of the business is what the buyer is willing to pay. And so, that is a reality that is always underpinning such a transaction. When we talk about sellers on this slide, it's common for a business to pass that entity on to the next generation. It's clearly convenient because you've got the next transition sitting in front of you, has perhaps worked with you for many years, but the risk of preaching to the choir here, this is a process, it's not an event. Steve had mentioned earlier on, this is not a transaction that should take place over a sort of a 6-month period or even less. For this to be a successful transition, both parties must buy in, and especially when it's an internal transaction, it's really important to verify that, let's say a family member is who you've got in mind. Does that family member truly want to do this? And do they truly possess the skill set to take it on? You need to have an honest two-way conversation over a period of time to determine whether, is this just the most expedient way to think about a transition, or is this truly going to be have a successful outcome? Just because you may be passing the business on to a family member or an internal employee does not excuse you from preparing the same way as you would for an outside buyer. Conversely, that internal buyer ought to be performing the same degree of due diligence as an external buyer would do. In the absence of those activities, you're setting yourselves up for surprises and recriminations after the fact. So when considering transfer, let's say to a family member, be extra careful to divorce your emotions from a clear-eyed analysis of whether that buyer has the necessary skill set to take this over. Otherwise, you may be not only jeopardizing the business, but setting your family up for pain and suffering and jeopardizing the future of that business you so lovingly developed. Personas. A persona is a description of who you believe to be an ideal candidate for passing on this entity. Be able to describe them as if they were a real person, because frankly, they will be a real person. And it helps you to understand, how to identify those folks if you can articulate the attributes that would attract them to your business. So as part of the succession plan, it's a good idea to spend some time thinking about who your target buyer really is. What do they like? What's their, their ideal attributes that would make them both interested and successful in taking over your entity. Engaging a broker is not a requirement, and obviously has a cost associated with it. But if you are spending time trying to identify the ideal buyer, you may be taking your eye off the ball of your business. So one suggestion is to stick to your core competency and outsource what you are not as proficient in. And a broker can be very helpful in identifying those personas that you have previously identified. So this is really important for a broker to understand who they're looking for. There are examples where a seller may decide that because they want a premium price for their business, the persona that fits that potential buyer may be very hard to find. And if a broker knows that up front, they may be able to caution you about limiting your horizons in too small a way, and that makes it very difficult to find that typical buyer based on the attributes that you've identified. So this exercise is really worth doing because it will provide guidance as to how you frankly advertise what you're trying to sell, and if you are utilizing a broker, make it easier for that individual to identify the folks that would presumably have a significant interest in what you've got to sell.
So a few more thoughts. Well, back one slide, Chuck. You got,
Too fast.
yeah, we have a few more thoughts on seller that we want to continue with here. So aside from some of the discussion earlier about understanding your selling price, the range, minimum, maximum, and some of the overview issues Chuck just addressed with who your target potential direction of sale is, I wanted to talk a little bit more about drilling down into what the succession plan as a special form of business plan should actually address. So when we think about our business, we have what we call core value propositions. It's what you sell day to day, your products, your services, your consulting. And over the years, successful businesses learn very well how to communicate the strengths of their product, and that's how they succeed in selling it to your customer base. So when we look at the overall end game here, the goal of a succession plan is essentially the sale, obviously, of your whole business. So just like we put incredible detail into extolling the benefits of our products to our consumers, we have to do the same thing about our business as a whole when we consider the selling of that business to a potential buyer. So the goal of a succession plan, aside from presenting the factual data that underlines its valuation, is to tell a compelling story. After all, you're actually trying to sell this thing. Just like we have an elevator pitch to sell whatever it is we're making, we have to have a compelling story to show the value of our business to our targeted buyer, to that persona that Chuck just talked about. So a compelling story has to understand, where is this business going to go? The financials and the valuation tell the history of your business, but a buyer is interested not only in the history, but the future. They're investing in the future. So your compelling story has to show how your business is poised for a very positive, profitable future to the potential buyer. So as a seller, what are you going to do to demonstrate the positive future of your business? You have to show, perhaps for the last 5 years, there are several key opportunities to expand or grow your business. You're aware of them. but you are no longer in a position to take those opportunities. But those opportunities now become opportunities for your successor. The dreams and visions that you've had, that you know they're feasible, those are the things that may tell the story for your potential buyer. The more that you can bring out that story in a business plan / succession plan in a way where you show the growth potential. These are the types of investments and these are the type of returns that this business could yield, starts to make it attractive to your potential buyer. It also ties back into the persona. Different buyers come into businesses with different levels of investment, different capabilities. If you have a buyer who is very well capitalized, they may have the depth to take your business and grow it to levels that way exceed what you've done, and they're attracted by that. Other buyers may want to take over a stable, steady business, and they're not looking to radically grow it. So the compelling story to that sort of buyer is the stability of the business, the steady Eddie approach that just yields a stable, consistent profit year after year. So the compelling story is driven somewhat by the persona and vice versa. So that's the job of you as seller, and the succession plan is to develop that compelling story, to make the case for the future, and to demonstrate that case with realistic projections and realistic history. The other thing I wanted to go back to a little bit, Chuck mentioned a lot about internal transfers, transfer or sale of the business to a family member or an internal candidate. A few more thoughts along those lines, and actually they could even potentially apply to an external buyer, is training. So if you're planning to transfer your business to a key player, family member, internal employee, you would want to start training that individual in the more leadership management aspects of that business well in advance of the transfer, so that they are prepared and confident, and that you are prepared and confident that they can succeed. So a well-timed training program that's comprehensive should start well in advance of the succession plan. May involve rotating that person through different areas of the business, letting them roll up their sleeves and get involved in various aspects of the business that are outside their normal function as an employee or family member. And by the way, that's often a component of selling a business. Very often, the sale or transfer of a business to an outside buyer does involve a training transfer period where the new ownership comes in, there's an overlap, and you as seller mentor and coach that transfer over a period of time so that the buyer has the benefit of your input during a transition period. Another thing about the transfer, sort of building on that, is again the timetable. It wouldn't be unreasonable to think of starting a succession plan 5 years in advance, ideally. If not, at least a couple years, and have very clear milestones and specific tasks that have to be accomplished within that timetable. Obviously, you're thinking about typically, well, not always, but often a succession of a business plan is rolled up with the idea of retirement. So what other retirement planning is going on in the background, and how does that line up with your sale or transfer? So again, all of these things are part of it, and that's why it takes a lot of lead time to bring all these pieces together. Another important part here clearly is legal representation. There's always the do-it-yourself approach and for sale by owner and those sorts of things. However, that doesn't mean that you should opt out of proper legal representation. You should have the deal reviewed and guided by your business attorney, and being very sure that all those technical legal things are taken care of and there's no surprises when it comes to closing day. So your legal representation, of course, needs to be involved very early on, and they need to be in the loop. As we all know, it's very difficult to bring legal representation into any problem last minute. So that needs to be dealt with early. Other areas that sometimes aren't given due diligence are things like life insurance, key person insurance. It's a fact of life that sometimes unfortunate circumstances force premature closure or succession of a business, such as death of an owner or key partner. So key person insurance can alleviate those problems. Simply a life insurance policy taken out on owners, partners, payable to the business can go a long way in averting potential catastrophes involved with unforeseen circumstances. So that's another aspect of succession planning, more along the lines of prevention of sort of catastrophic occurrences in the midst of your succession plan. So at this point, Chuck's going to move on to thinking a little more about the buyer.
Thanks, Steve. We're sort of hammering home a number of points here, and the risk of repeating ourselves. Want to stress that, from the buyer's perspective, they're absolutely going to expect comprehensive financial data. So assume that you will be asked for at least 3 years of tax returns, as well as profit and loss, which you should consider to be the history of how you've been doing, balance sheets, which are a snapshot of how you're doing currently, and cash flow statements, which are effectively projections of the future or your budget. If there is a significant disconnect between what the tax return story is and what your profit and loss statements are, that can certainly be a red flag to a buyer. So be prepared to explain any potential discrepancies that might reveal themselves in analysis of those documents. Clearly, the weaker the business is, the more leverage the buyer has to negotiate favorable terms. So, the time spent on your side preparing the succession plan that tells the strongest story stands you in good stead when it comes down to negotiation. As Steve said, legal representation is key. You're going to need a purchase agreement, and it should be one that is developed without your hands tied behind your back. So have utilize the experience of folks who've done this more than once, and that would be your legal representation. Assume that the buyer will counter your valuation. I've seen instances where that hasn't occurred, and I would say that is a demonstration of a seller, really having the upper hand and having an inexperienced buyer who is probably not prepared to take over the business appropriately. Your business is to sell the vision. Your job is to sell that vision and persuade the buyer that this is a great opportunity. And that should come out in the succession plan that you're developing. But at the end of the day, the business is worth, as we've said before, what a buyer is willing to pay. And all of this preparation is fodder for underpinning your argument that the business is worth what you say it is. Keep in mind that a buyer may only be interested in acquiring your assets, not your liabilities. So anticipate that you may still have liabilities to take care of once the transaction is completed, or if they are assuming both assets and liabilities, make it really clear what those liabilities are so that there are no surprises after the fact. We've talked about this in a previous slide about the difference between a buyer's ceiling and a seller's floor. But be sensitive to the fact that that buyer may need to get more out of this transaction than you expect because of the cost of doing the transaction, for that individual as well.
I wanted to add a few thoughts on the buyer situation as well, a couple of anecdotes. So we talked earlier about the idea, Chuck mentioned the persona of the buyer. First of all, again, we have to think of every step in this thing as a process and not an event. Once you've gone through your homework, we've cleaned up the financials, we've gone through evaluating the business. You, the seller, are prepared to tell your compelling story. And now we're at step 4, finding this buyer. Of course, this is where it all comes together. And this can also be a very involved process. Sometimes it can go on for months, even years. I can think of 2 examples I'm aware of. In one particular case, both actually involving wineries, large-scale transactions, got to this phase of actually engaging brokers to find buyers. Often brokers are real estate agents or affiliates. And in the one case, the buyer was located and a negotiation was entered that lasted a full year of back and forth. And the buyer had full legal counsel, had CPAs and accountants and analysis team behind them, went through every single number of that business in exceeding detail. It almost came to closing and making a deal on a couple of occasions. But, the buyer kept countering with a different valuation and different issues. And after a year of very intense negotiations, the deal fell through. And they started over. So again, it's a process, not an event. And you will not, the better degree of preparation in the preceding steps directly impact it the minute you start talking to a real buyer on the other end of the line. The other example, also involving a winery, was basically stemming from what was a very challenging persona. The buyer had sort of profiled the seller had sort of profiled the type of buyer, and they were essentially looking for what I call a legacy buyer. In other words, we're talking about a large winery estate worth in the millions, and however, the financials of the business were very, very weak, and the persona being sought after was someone who has huge amounts of resources to move in, purchase the business, and essentially run it as a tax shelter. This limited the market, and the deal and the seeking after that buyer was literally going on for years, and brokers that were involved were starting to lose vision. So that's an example of a very high expectation of a buyer with a very weak case on the part of the seller. Just two examples. So at this point, we're going to move on to taxes. We don't want to spend a lot of time on this, but it's something you have to be aware of. There are all kinds of tax considerations involved in estate planning and transfer of businesses. There are capital gains, there are taxes on assets. It can get very involved. So, of course, just like we advise legal counsel throughout this process, you are also going to need to retain a CPA, not a bookkeeper, but an actual certified public accountant, licensed, and they need to be involved early on as well to help you understand the tax liabilities that may be incurred with the sale or transfer of the business. If it's involving a family member, there are specific methods in which portions of businesses over time can be heired to a family member, and depending on the circumstances, capital gains taxes may be avoided. But a CPA is certainly needed in that process. Also, Chuck mentioned earlier, what types of liens are involved in the business? Are there unpaid taxes? Could be, to the IRS, could be to sales tax, could be state. All of that stuff has to be cleared up because a buyer is not going to be interested in inheriting any of your tax liabilities. So enough said about that. The key point is to involve a CPA early on.
So really, to wrap this up, the succession plan is your deliverable. It is effectively the business plan, and is your opportunity to tell the story, to make your pitch. This is the vehicle for exciting, attracting and exciting buyers, and to provide them with sufficient detail without writing a Bible to get you to the next meeting, ultimately, to begin the conversation. This is the marketing piece, and it effectively should include, all of the components that we've discussed previously today. What is the opportunity that is presented to the buyer? Why is this such a compelling, exciting, interesting proposition? And this is your chance to toot your horn about how you've built this, what the history has been, while you're doing that, you have to be cognizant of the fact that there is competition. There's competition for everything, even if the status quo is competition. You want to persuade customers to change from what they're doing to start frequenting your institution. So your buyer needs to understand what the lay of the land is in terms of competition. The personas, as we've discussed, help self-identify, who would be presumably interested in what you have to offer. And, obviously a potential buyer is going to flip to the financial summary and the valuation to see what, ultimately what you're looking for. Once all those sections have been developed, only then should you write your executive summary. And while that will come first, that generally should be written last, and should be a synthesis of everything that comes afterwards. So, the succession plan is the culmination of all this hard work, this, the thought, the conversations with your advisors, your family, and we invite you to include us in that conversation, as we will lay out now.
So just again in review, the succession planning program is an initiative of the Downtown Ithaca Alliance, aimed at the membership of the Alliance. Gary is very passionate about this and has coalesced our participation and support. So as we mentioned in the beginning, Chuck with the Small Business Development Center brings not only his own expert advice, but a whole network of support, including a research component in Albany that can produce a lot of data, a lot of information that may be key in your succession plan. Myself at Alternatives Federal Credit Union, Business Sense program. Business Sense has existed at the credit union for over 10 years. We've been involved in advising literally hundreds of small businesses through startup, through expansion, capitalization, getting loans, and dealing with all the day-to-day problems of small business. So we are pleased to, be part of this partnership, and we would hope that those of you facing this challenge would really take this opportunity to avail yourselves of this help. It's a great opportunity through the Downtown Alliance.
Well, Chuck and Steve, I wanted to just kind of jump in here for a minute and indicate that this introductory webinar is intended to help get people at least acquainted with the idea of succession planning. What we want to do with members of the Downtown Alliance is offer the opportunity for them to work with us and you all on putting together specific succession plans for their businesses. And we have this partnership that's together with AFCU and the Small Business Development Center to help make that happen. We have a finite number that we can work with, and if we exceed that number, what we will do then is have to pick some people in terms of ones that we can get going in the process. But I think we have the opportunity to work with a number of businesses to help them come up over the next months with real specific and tangible and custom plans for their businesses, whether you need them soon or whether you need them in the distant future. And that's the idea behind this whole process. Why don't we go to some questions? We have, I've got a list of questions here that have been coming in. Here's one question. Can this type of plan, a succession plan, be used to attract partners that will invest and possibly take over the business? What specific adjustments would it need to target in order to bring on a partner? So it's a question about a business that doesn't have partners at the moment, but is thinking about how one does that. And so how does a plan help someone prepare for or think about doing that?
Well, the succession plan is a business plan, and if you're seeking investors or partners, we would certainly advise our clients to develop a business plan. So it does not necessarily have to be resulting in succession. It could be resulting in bringing on partners. The process is very much the same. However, it's analyzing, the attributes of the business. Again, what the competition is, what your marketing plan would be, which is important if you're going to continue to be involved in the business, who you are. So the team is very important if you're trying to bring on others with a succession plan. It doesn't matter because you're leaving, but if you're looking to attract partners or investors, they're going to be very interested in who you are because presumably you're still going to be involved in the business itself. Financial analysis is still the same. So there's some slight differences, but the succession plan / business plan is the vehicle that you would be developing first. So because that's what a presumptive partner is going to be looking for.
I would also add to that, one key difference between solving that problem and a succession plan is something called a partnership agreement. A partnership agreement would be a completely separate document that would become an appendix to or a part of the success. In this case, wouldn't truly be succession, but let's say the business plan. And the partnership agreement is a involved process, often a mediated process, where prospective partners literally hammer out in writing the terms and conditions, the roles, the responsibilities of their future activity together. I've assisted in preparing partnership agreements for people going into business together. Some of them have taken weeks to develop. So in that case, I would highly recommend that the partnership agreement would be made part of that plan.
And done in conjunction with legal representation.
Okay, good. Thank you. Here's some other questions. Another question. I am a small retail business. Can I get a business valuation without spending lots of money? So it really comes down to that question. How does how does that valuation process work, particularly for some of our smaller retail businesses?
Well, that would be that's a very good question, and that's a key part of this initiative, the succession plan program that we're describing today. The slide that you see on the screen right now sort of defines the different roles of each of us three partners here in this program. And the valuation would be part of it. And these types of services would come through Chuck and myself as part of this plan. So there will be some costs involved in producing final deliverables, but those costs will be modest and realistic.
Just to sort of underscore that, if you are a client of the Small Business Development Center, there are no fees associated with being a client. We do not produce valuations for you, whereas perhaps alternatives, would do that. What we would do is provide you with research on how you might go about doing a valuation if you did it yourself. So we would be a trusted advisor there. We would not be doing the valuation. But as I indicated earlier, with a restaurant client that I was working with, I gave them a couple of algorithms that are used in that industry to determine valuation. Steve's services are slightly different. They're complementary, but different.
Yeah, and so in the process, again, back to this slide, what we anticipate is that Downtown Ithaca Alliance, Gary, will be working with you to communicate the program, to coordinating enrollment of those who want to participate. Then Chuck at Small Business Development Center will be assisting you, interviewing you, helping you to get your financials in order, to get your underlying business history and data together. Those services are completely free of charge. Then when Chuck is done gathering the initial information, again, referring to our circle, step one, financial, step two, valuation. Chuck will help work with you to get that stuff together. And then the third step is actually doing business analysis and helping to put together the numbers and the pieces that go into the succession plan. A lot of that work will be done by yourselves. Alternatives Federal Credit Union, myself can come into that and provide services that you may not feel comfortable doing. We can do that. And some of that will be on a fee-for-service basis, but it will be affordable and modest. So it's kind of a flow.
All right. Thank you, guys. Here's another question. What about a business that is currently losing money, but still has upside potential? How is that valued? And I guess there's a related question to that. I think the two things kind of combine here. Sometimes businesses get tired and they trend downward. But is there a case to be made that the business could grow with but there is a case to be made that the business could grow with new blood? How is this valued or modeled?
Well, first of all, it's described, as part of again, in the succession plan is an acknowledgement that perhaps, resources have been limited in terms of marketing. And if those resources were increased through the auspices of a new buyer, then here are some ideas that could be put in place that could generate additional revenue. So I think it's a frank analysis of and an acknowledgement that perhaps fewer resources have been devoted to growing the business because of personal reasons. But you still have to make the case that were those resources available through a new infusion perhaps, then there is great opportunity, but you have to help make that case. You just may say, I'm not the person that to do that now, but the opportunity still exists.
Yeah, and I would double that, ditto what Chuck said. A way to think about it that I found helpful is that the growth of a business typically goes through phases. There are different types of capitalization that follow sort of typical growth patterns. So when a business initially launches, for example, as most of us are painfully aware, we end up going to friends and family and scraping to save and out of pocket because often in the startup level, we may not be bankable. So it's difficult sometimes to find that startup money. So you go through this very entrepreneurial phase, and people that start businesses are your type A driver entrepreneurs, and they just get out there and make it happen. Then the business starts to grow and mature. The sort of cowboy adventure of it settles down. Some management comes into play. The business generates revenue, starts to become bankable. The next level of growth beyond that sort of startup chaos is commercial lending. The business is sort of stable. It may not be getting rich, may even be somewhat, not profitable as the question alludes to. However, there's some commercial credit in play now and it's going to the next step. And then the third sort of phase that a business can experience, and this is often, very often, where the small business that's been successful, been out there 20, 30 years, it's now time for the succession. Typically, they're at this place where the fruits of their labor have literally made them very attractive. They, yes, they may not be as profitable, exactly a situation being described, but there may be a tremendous amount of goodwill built up. There may be a huge loyalty or following, an awesome product. And however, we're tapped out. We've been at it 20, 30 years. We don't have that last final thing. And this is often the place where venture capital comes in, where the business transitions from that cowboy entrepreneur through that sort of middle management phase, and it's poised for real growth, even if there are those vulnerabilities. But someone could come in, the venture capital side, buy out that business. They may even be part of a conglomerate that absorbs it. A good example of that I can think of recently, if you know the cheese world, was Vermont Butter and Cheese. Their products are sold here locally in Wegmans. They were a family business, started off as pioneers in their industry of artisanal cheese, grew their business, and 30 years in, the owners are tired, and Land O'Lakes out of the Midwest comes in, multi-million-dollar operation, buys them out, and is taking them to the next level. So I would say that, yes, there's very much hope for those situations. But as Chuck said, it's incumbent upon you, the seller, to tell that compelling story. What's the goodwill you've built? What's the value you've built? What's the loyalty you've built? And a good investor can just hop, skip over your relatively minor financial problem if their pockets are deep enough and you present an opportunity that's compelling to them.
Okay, thanks, guys. Here's another one. I don't have a family member or a key employee at this point in time. How do I take the steps to find and mentor a key employee going down the road?
That is a situation, first of all, we can't skirt around. It's time. It's a very time-intensive process. The definition of a key employee is someone who's been around a while, who understands the inner workings of your business, not only understands the inner workings of the business, but has a passion for that business and sees a future in the business. So that is not the kind of situation that's, it's not an overnight occurrence. There's also a lot of subjective elements to that, i.e. trust. Trust and respect are built over time. So I think you have to take a long-term look at the key employee approach. I don't think that's a quick fix.
Okay. Here's one more here regarding training programs. If somebody wants to get involved with a training program for an employee or mentoring a potential partner, is that something that involves fees? Do you require them to pay for this? Do you do this before a sale is set? Or maybe talk a little bit about that issue.
Well, just sort of to reiterate, if you are working with us at SBDC, there are no fees involved, and our services are pretty broad as sort of trusted advisors. In terms of doing training, we wouldn't be training your employee, but we would be working with you to ensure that the training that you're doing with the employee touches all the right bases. Right. So that's what I'd say, involvement with SBDC, that's sort of where it begins and ends.
And that makes sense for that relationship. I think what this is referring to is a question of when a business starts working to mentor or train someone who might be interested in taking over a business.
Yeah. Okay.
Do you do that without putting together a fee arrangement with them, the mentoree or the person receiving the assistance, the help from the current owner? I guess that's the question that comes down to it is what's that relationship, and is it always sort of a remunerated sort of situation, or is it one where it can be done on faith or goodwill? Or talk a little bit about that.
I guess I would preface it by saying it's a complete negotiation. It's also not one-dimensional. I think the type of mentoring and training that would be involved in the transfer of a business is very specific to the business. I can give an example from my own experience. When my wife and I acquired Lively Run Goat Dairy from the previous owners, we negotiated a training period where we worked together with the previous owners for a summer, essentially, and there was no money involved. It was just a goodwill agreement because we were buying the business and the seller wanted to sell the business, and the training was simply necessary to make that deal possible. So there was no money involved whatsoever. We just began to work alongside the previous owners during that training period, and then we were launched. I would also, building on what Chuck said, you have to sit down, frankly, the buyer and seller, and discuss all of the key competencies, I would call the core competencies that the transfer requires. And, the buyer will come to the table with some of those core competencies in place, but there will be very specific areas where those core competencies are not in place. Like for us, when we purchased Lively Run Goat Dairy, we had virtually no experience in making cheese. So the training program involved hands-on cheese making and technical mentoring. However, we had business skills at that time that we didn't need training on. So whatever that profile is, there has to be a negotiation on obtaining that training. It could be from the previous owner, but it could also be, hey, you ought to go sign up for a business class, or go avail yourself of SBDC mentoring, or what have you. So I think it's a negotiated thing.
Okay, well, thank you very much, guys. Those are the questions that we have. I think at this point we will wrap this up. Couple final comments. One would be, if you are a downtown business and you would like to work on a succession plan for your business, please email us here at the DIA, and we would be happy to work with you to get you in touch with both Chuck and Steve, and put together a potential plan, put together a process for you to put that plan together. If you want to get more information about this, please let us know. We will be putting this webinar up in its recorded form on our website in a couple days. And we will also have the slides available for people if they want them. So thank you very much for attending today and participating, and we look forward to talking to you again. Thank you.
Thank you.
Thank you.
Thanks, guys. Yep.